So, if you're out there shopping for a new home, you've definitely seen them. These incredible, almost unbelievable low mortgage rates offered directly by the builders. It's so tempting, right? It looks like it can make that brand new home way more affordable. But is it really as good as it looks? Let's dig in and find out what's really going on behind the scenes with these builder mortgages.
I mean, the appeal is just staring you right in the face. On one side, you've got this amazing promotional rate from the builder, maybe as low as 3.99%. And on the other, you've got the current market rate sitting at over 6%. That difference could literally save you hundreds of dollars every single month. It seems like an absolute no-brainer. But, when a deal looks this good, you just have to ask.
Seriously, how can a builder offer a rate that's so much lower than what pretty much every other lender out there is offering? What's the secret? Is it some kind of financial magic, a special government deal? Well, no. It's actually a very specific financial strategy, and you've got to understand it to see the true cost.
Okay, so let's pull back the curtain and really look at the mechanism these huge builders are using. This isn't about them finding a cheaper bank or anything like that. No, it's about fundamentally changing how the loans themselves are bought and sold.
The secret sauce here is something called forward commitments. Okay, think of it like this. Imagine a giant grocery store chain knows they'll need 1 million apples next fall. Instead of just waiting and paying whatever the market price is, then they make a deal with farmers today to buy all those apples at a fixed discounted price. Well, builders do the exact same thing, just with mortgages. They use their enormous size to buy up huge bundles of loans from lenders, locking in those low rates months and months in advance.
And this strategy, well, it gives the builder a massive competitive edge. They can dangle that super low rate to get buyers in the door, they can sweeten the pot with other incentives, and they just plain outmaneuver smaller sellers who can't possibly compete with that. It is a really powerful tool for selling homes fast.
Which leads us to the most important question of all. The builder got a discount from the lender, sure, but that doesn't mean they're just passing those savings on to you out of the kindness of their hearts. That low rate has a cost, and that cost has to be covered somewhere. So where is it? And this, my friends, brings us to the hidden trade-off. Because like the old saying goes, there is no such thing as a free lunch. And that is especially true in real estate. The savings you think you're getting on your interest rate, they come at a price, and it's a price that's baked right into the house itself.
Now here is the big psychological trick. It's the key thing that so many buyers misunderstand. The builder isn't actually giving you a discount on the loan. They're just shifting the cost. And this is where they shift it. The data, looking at the years 2019 to 2024, shows that to cover that sweet low rate, builders inflate the home sales price by an average of 6%. So yeah, you save on interest, but you end up overpaying for the actual house. That money goes right back into the builder's pocket through that higher sticker price.
The builder's math here is actually pretty simple. First, lure you in with an amazing rate. Second, quietly build the cost of that rate into the home's list price. And third, sell the house way faster. For them, it's so much smarter than just doing a visible price cut. It makes the home feel more affordable every month, even though your total debt is actually much, much higher.
So while this strategy is fantastic for the builder's bottom line, what does it mean for yours? Well, that higher total debt has a serious immediate consequence for you, the buyer. And this isn't some problem that might pop up in a few years. No, it's a financial reality from the second you get the keys.
This is really the perfect way to think about it. We all know how new cars depreciate, right? You finance a car for, say, $30,000, but the second you drive it off the lot, its real market value might only be $27,000. Boom, you owe more than it's worth. The exact same thing is happening here. You've basically paid a 6% premium for your house, and you financed it right into your mortgage.
So let's be still clear about what underwater really means. It's simple. You owe more money on your mortgage than your house is actually worth on the open market. This can wipe out your equity from day one, and it makes it incredibly difficult to sell or refinance later without having to bring a big check to the closing table. Okay, so how serious is this in the real world? Let's get into the hard data, because this is where the long-term danger really becomes clear. It puts a lot of homeowners into a financial danger zone, with debt levels that are just really hard to sustain.
This is a pretty sobering statistic. The data shows that about 1 in 5, that's 20%, of buyers who take these low-rate builder mortgages are immediately underwater, from day one. Just think about that. 1 out of every 5 of these new homeowners owes more on their house than it's actually worth.
And here it is. This is that danger zone we're talking about.
For many of these borrowers, their monthly mortgage payment eats up a staggering 43% of their take-home pay. That's their debt-to-income or DTI ratio. Now compare that to a recommended maximum of 25%. When you're at 43%, there's almost no room left for a surprise car repair, a medical bill, or really any of life's unexpected curveballs.
So what you end up with is this really toxic combination, being underwater on the loan plus having a dangerously high debt-to-income ratio. And when you put those two things together, it dramatically increases the long-term risk of mortgage default. You're starting out in a really precarious financial spot.
So, after looking at the inflated prices, the high debt ratios, what's the bottom line here? It all really boils down to one critical question that every single home buyer needs to ask themselves when they see one of these deals.
And that's the ultimate trade-off, isn't it? Is that immediate satisfaction of a lower monthly payment worth the long-term risk of starting your journey as a homeowner with an inflated home price, zero equity, and a dangerously high level of debt? There's no easy answer, but it's a decision you're now equipped to make with your eyes wide open.